What if the financial world as you know it just stopped making sense? What if Bitcoin ETFs, the golden goose of the cryptocurrency world, suddenly crashed? Picture this. It's a sunny Monday morning. You're sipping on your coffee, scrolling through your phone when your heart skips a beat. The headlines are screaming, Bitcoin ETFs have crashed. The financial world is reeling, investors are in shock, and you're left wondering, how did this happen? Bitcoin ETFs, or exchange-traded funds, have long been hailed as the golden goose of the cryptocurrency world. They were the next big thing, the game changer that would bring Bitcoin and other cryptocurrencies into the mainstream. Imagine the lure of investing in the volatile world of cryptocurrencies, but with a safety net. That was the allure of Bitcoin ETFs. They offered a way for the everyday investor to dip their toes into the crypto waters without the risk of direct ownership. They were supposed to be the bridge between Wall Street and the Wild West of cryptocurrency. Yet, the optimism surrounding Bitcoin ETFs was not unfounded. The promise of diversification, liquidity, and the potential for high returns made them an attractive investment. The stage was set, the players were ready, and the world watched with bated breath as Bitcoin ETFs took the financial world by storm. But then, like a bolt from the blue, the unforeseen happened. Bitcoin ETFs, once the shining beacon of hope for cryptocurrency enthusiasts, crashed. The impact was immediate and far-reaching. Investors watched in disbelief as their investments plummeted. The golden goose had turned into a lead balloon. Just like that, dreams were shattered, fortunes lost. But what really happened? Let's delve into the heart of the matter, peel back the layers, and uncover the truth behind the Bitcoin ETF crash. To fully understand the crash, we need to take a step back. Let's rewind to the time when Bitcoin ETFs were the talk of the town. The emergence of Bitcoin ETFs, or exchange-traded funds, was a monumental moment in the financial world. These funds, which tracked the price of Bitcoin, were seen as a new way to tap into the lucrative potential of cryptocurrency without the risks of direct ownership. They were embraced by investors around the globe, from Wall Street to Silicon Valley, as a golden ticket to the Bitcoin bonanza. Bitcoin ETFs brought the cryptocurrency market to the mainstream, offering a level of accessibility and simplicity that was previously unheard of. The allure was irresistible. Here was an investment opportunity that promised the thrill of the crypto market with the ease of traditional investing. And for a while, it seemed like a win-win situation. The rise of Bitcoin ETFs was nothing short of meteoric. In a few short years, they went from being a niche product to a mainstream investment tool. Billions of dollars flowed into these funds, driving their value to dizzying heights. The future seemed bright, and the promise of easy profits was hard to resist. But as we know, what goes up must come down. And with Bitcoin ETFs, the fall was just as dramatic as the rise. A combination of regulatory crackdowns, market volatility, and investor panic led to a sharp decline in the value of these funds. It was a stark reminder of the risks inherent in the crypto market. The fall of Bitcoin ETFs was a shock to many. But in retrospect, there were signs of trouble brewing. The rapid growth and sky-high valuations were unsustainable. The market was overheated, driven by speculation rather than fundamentals. And then, the unthinkable happened, the crash. The crash was swift and brutal, but what caused it? To understand the crash, we must delve into the murky waters of market volatility. The financial world is a place where fortunes can be made or lost in the blink of an eye, and Bitcoin ETFs proved to be no exception. As the popularity of Bitcoin surged, so did the volatility. Prices shot up and down, fueled by a combination of hype, speculation, and the pure unpredictability of the cryptocurrency market. This level of instability was a clear risk factor, but many investors turned a blind eye, entranced by the allure of quick profits. This volatility was further exacerbated by regulatory issues. Cryptocurrencies have always been a source of concern for regulators around the world, and Bitcoin ETFs were no different. Despite the initial enthusiasm, regulators began to express concerns about the lack of transparency and potential for market manipulation in the Bitcoin market. The regulatory landscape was shifting, and with it, the fortune of Bitcoin ETFs. Moreover, other potential causes can't be overlooked. The overall economic climate, the performance of other investments, and even the sentiment of investors can all play a role in triggering a crash. In the case of Bitcoin ETFs, a perfect storm of factors came together to create an environment ripe for a crash. Let's bring in some hard facts to support this discussion. In the weeks leading up to the crash, Bitcoin ETFs were trading at record highs. However, under the surface, the signs of instability were clear. The market was highly volatile, with prices swinging wildly from day to day. Regulatory concerns were mounting, with several high-profile authorities expressing unease about the lack of oversight in the market. And overall, investor sentiment was increasingly bearish, a clear warning sign that all was not well. To sum it up, the crash of the Bitcoin ETFs was a culmination of market volatility, regulatory challenges, and a host of other factors. It was a brutal reminder of the risks inherent in the world of finance, particularly when dealing with novel and unregulated investments like Bitcoin ETFs. But was there a way to see it coming? Every crash has its warning signs, and the Bitcoin ETF crash was no different. A storm was brewing, and the signs were there for everyone to see. Let's rewind the clock and delve into the overlooked warnings that were the harbingers of this financial tempest. To start with, we saw an unusual divergence. Bitcoin ETF prices were skyrocketing, while the value of Bitcoin itself was on a downward slope. This disconnect between the ETF and the underlying asset was a clear alarm bell. However, the allure of quick profits overshadowed this glaring anomaly. Secondly, the volume of trading in Bitcoin ETFs was dwindling. A healthy market is characterized by robust trading volumes, but in the days leading up to the crash, the trading volumes for Bitcoin ETFs saw a significant drop. This was a clear sign that investor interest was waning, yet it went largely ignored. Thirdly, market sentiment was overly bullish. Yes, optimism is good, but when it turns into irrational exuberance, it's a red flag. Investors were piling into Bitcoin ETFs, oblivious to the market realities. The Fear and Greed Index, a barometer of investor sentiment, was flashing extreme greed, a classic sign of an impending crash. Lastly, the regulatory landscape was growing increasingly unfavorable. Regulators around the world were expressing concerns about the risks associated with Bitcoin ETFs. Yet these warnings fell on deaf ears as the frenzy continued unabated. These were not mere coincidences or random occurrences. They were stark warning signs, flashing like a lighthouse in a stormy sea. But in the grip of greed and fear, these signals were drowned out. Hindsight is 20/20. But what's the impact of this crash? As we look back, it's crucial to remember that ignoring warning signs can lead to disastrous consequences. But let's not dwell in the past. Instead, let's turn our focus to the aftermath of the crash and the lessons that we can glean from this financial debacle. The aftermath of the crash was devastating, but just how bad was it? Imagine a hurricane sweeping through a city, leaving nothing but destruction in its wake. Now translate that image into the financial realm, and you'll begin to grasp the magnitude of the Bitcoin ETF crash. It was not just a storm, it was a financial whirlwind that left investors and markets reeling. The investors, those brave souls who ventured into the high-risk, high-reward world of Bitcoin ETFs, bore the brunt of this disaster. Many saw their portfolios decimated, their dreams of financial independence shattered. For some, the losses were in the thousands, for others in the millions. The figures, though stark, only tell part of the story. Behind each statistic is a tale of hopes dashed and financial security jeopardized. But the devastation didn't stop at individual investors. The cryptocurrency market, once a beacon of hope for those seeking to break free from traditional financial systems, was hit hard. The crash knocked the wind out of Bitcoin, causing its value to plummet. The ripple effects were felt across the entire crypto market, with other digital currencies also experiencing steep declines. In a matter of days, billions of dollars in market capitalization evaporated into thin air. The broader financial market was not spared either. Confidence waned, volatility spiked, and traditional investors began to question the stability of an industry that could experience such a catastrophic event. The crash served as a stark reminder of the inherent risks associated with investing in emerging and unregulated markets. It was a wake-up call for regulators and a reality check for Wall Street. The aftermath of the crash was not just about financial loss. It was about broken trust and shaken faith. It was a stark reminder that while the world of finance may be changing, the principles of sound investing remain the same: diversification, due diligence, and a keen understanding of risk. The Bitcoin ETF crash was not just an event, it was a moment in financial history that will be studied and analyzed for years to come. Its impact was far-reaching, its lessons profound. A financial disaster indeed, but what's the lesson here? Every crash is a harsh teacher. So what have we learned from the Bitcoin ETF crash? Let's delve into the key takeaways from this financial storm. First and foremost, it's clear that investing in volatile markets is not for the faint-hearted. It's like riding a roller coaster blindfolded. Exhilarating for sure, but also potentially disastrous. The Bitcoin ETF crash has taught us that volatility is the name of the game in such markets, and it's a game not everyone can play. The crash also highlighted the inherent risks associated with investing in digital assets. While the allure of high returns is tempting, the potential for equally high losses is a reality that cannot be ignored. It's a balancing act, a tightrope walk, if you will, between risk and reward. This crash has served as a stark reminder that what goes up can and often does come crashing down. But it's not all doom and gloom. The crash has also illuminated the dire need for regulatory clarity in the world of digital assets. The lack of clear rules and guidelines has often left investors navigating uncharted waters, making investment decisions more of a gamble than a calculated risk. The crash has underscored the urgency for regulators to step in and provide the much-needed guidance to help investors make more informed decisions. We've also learned that diversification is key. Putting all your eggs in one basket, or in this case one digital asset, may not be the wisest move. Diversification can act as a hedge against the volatility of a single investment. It's a lesson many learned the hard way in the aftermath of the Bitcoin ETF crash. Lastly, the crash has taught us the importance of due diligence. It's not enough to jump on the bandwagon based on hype and speculation. A thorough understanding of the investment, its underlying technology, and market trends is crucial. A costly lesson, but a necessary one. The crash was a setback, but is it the end of the road for Bitcoin ETFs? As with any financial instrument, the future of Bitcoin exchange-traded funds, or ETFs, is anything but certain. The crash was a harsh reality check, a stark reminder that even the most promising ventures can stumble. Yet, it's also important to remember that setbacks can often pave the way for remarkable comebacks. So, what does the future hold for Bitcoin ETFs? Well, let's consider a few factors. Firstly, the lessons learned from the crash. The crash was a wake-up call for many investors who were swept up in the hype of Bitcoin ETFs. It underscored the volatility and unpredictability of the cryptocurrency market, teaching investors to approach with caution and make informed decisions. This newfound prudence could help stabilize the market, making it more attractive for cautious investors and potentially leading to a more sustainable growth in the future. Secondly, the ongoing interest in cryptocurrency investments. Despite the crash, the allure of cryptocurrencies remains strong. They are seen by many as the future of finance, a digital gold, if you will. This interest is not likely to wane anytime soon. In fact, with more people becoming digitally savvy, the interest in cryptocurrencies and consequently Bitcoin ETFs could potentially rise. Thirdly, the regulatory landscape. The crash has undoubtedly caught the attention of regulators worldwide. While this could lead to stricter regulations, which might initially seem like a setback, it could also bring about much-needed clarity and guidelines for the cryptocurrency market. This could potentially make Bitcoin ETFs more secure and trustworthy, attracting more traditional investors and large institutions. And finally, the resilience of the Bitcoin market. Bitcoin has been around for over a decade now, and it has weathered numerous storms. Each crash has been followed by a recovery, sometimes even reaching new heights. This resilience could bode well for the future of Bitcoin ETFs. In conclusion, while the crash was a setback, it doesn't necessarily spell the end for Bitcoin ETFs. The lessons learned, the ongoing interest in cryptocurrencies, the potential changes in the regulatory landscape, and the resilience of the Bitcoin market could all contribute to a promising future for Bitcoin ETFs. However, as with all things in the financial world, nothing is guaranteed. The future of Bitcoin ETFs, as with Bitcoin itself, is laden with potential but also fraught with uncertainty. Only time will tell if Bitcoin ETFs can rise from the ashes. The Bitcoin ETF crash was a financial storm that left destruction in its wake, but it also left us with some valuable insights. As we draw this discussion to a close, let's take a moment to reflect on the tumultuous journey we've embarked upon. We've explored the rise and fall of Bitcoin ETFs, delved into the specifics of the crash, and examined the warning signs that were there, albeit unnoticed or ignored by many. The crash was a stark reminder of the volatility inherent in cryptocurrency investments. Bitcoin ETFs, once hailed as the golden child of the crypto world, experienced a dramatic downfall that left many investors reeling. We saw billions of dollars wiped off the market in a matter of hours, demonstrating the high-risk, high-reward nature of these investments. Yet, amidst the chaos and uncertainty, there were lessons to be learned. The aftermath of the crash served as a sobering reminder to diversify our investment portfolios, to not put all our eggs in one basket. It reminded us of the importance of doing our due diligence, of studying market trends and understanding the risks involved before diving headfirst into any investment. The future of Bitcoin ETFs remains uncertain. While some believe they will rise from the ashes, others are more skeptical. What is certain, however, is that this event has fundamentally changed the way we view and approach cryptocurrency investments. It has sparked conversations about the need for more stringent regulations and better investor education, discussions that will shape the future of the crypto world. As we ponder on these key takeaways, let's not forget the most important lesson of all. In the world of finance, there is no such thing as a sure bet. Every investment comes with its own set of risks and rewards, and it is up to us to navigate these complexities. It is up to us to learn from our past mistakes, to adapt to changing market conditions, and to grow as investors. In closing, remember this: in the world of finance, as in life, there are no guarantees, only opportunities to learn, adapt, and grow. As we move forward, let's take these words to heart, using the lessons learned from the Bitcoin ETF crash as a stepping stone towards smarter, more informed investment decisions.